Hello, hello. Good morning, everyone. It is Monday. Monday, March 11th. They changed the times in Eastern time this past weekend, so it's an hour earlier here in Europe. I hope everyone's doing well. So, we've got a few things to talk about today. First and foremost, contract rollover. Every quarter, the third Friday of the final month of the quarter, we roll over contracts, right? We get the expiration of the current contract, and we get the Quad Witch event on Friday, which are generally more sporadic and volatile and wonky days. This week is setting up to be one of those, I think, larger swings, more volatility, kind of wonky weeks ahead. We have Monday. Today's the first day that I believe that we're going to. It'd be beneficial to roll over to the following month, right? If you trade equity futures, the general prognosis is or the general, like, I guess, acronym would be like hummus, right? So HMUZ. So H is going to be March, which is expiring this coming Friday, and then we're moving over to the M, which happens to be the June, right? U is going to be September, and then Z is going to be December. So there's going to be a larger change in the pricing for the equity futures, right? Nasdaq and the S&P, they're going to be several tens of points higher than the prior month, right? Don't get confused uh, or I guess panic because you're like, oh my god, how did this gap? It is the contract rollover. So with those events in place, generally what happens is on Monday you'd probably want to roll over to the following contract. Because right now the volume between the two is fairly evenly split. I think that the H is still a bit heavier, but the M is most likely going to be heavier on volume by the end of the morning session, realistically. So, excuse me. I'm just gonna roll over on today, and this is gonna be the first day I'm gonna be trading the M contract. So with the M contract, it's going to be several points higher. We traded on the M, the 5200s on the S&P 500, and we're now trading back towards the H's prior highs pretty much from Friday's session. So keeping that in mind, understand that today is going to be the main day that I think most people change hands. So expect more sideways kind of wonky movement, I would say. Also, we have CPI tomorrow morning pre-market, which is going to bring in more of that kind of flatlining market action until we get that news event that new information is going to enter the market and you're going to have some kind of expansion move. So, leading into tomorrow pre-market, I suggest trade smaller, be more selective, don't get crazy on the day. We'll have enough opportunity in tomorrow's session, in my opinion. And let's dive into some of the news, right? It's now been 1 year, right, since the collapse of Silicon Valley Bank, and it's the anniversary, exactly 1 year, and there are many wondering if similar weaknesses that caused the regional crisis last March are still lingering. The most prominent of those worries has been centered around the New York Community Bank Corp, NYCB, which scooped up the assets of Signature Bank, another commercial lender that failed during the crisis of 2023. The last time around, the FDIC stepped in to facilitate the sales of failed banks and protect their insured deposits. But things would definitely be easier to handle ahead of time, especially if it meant trouble for the wider industry. So it's important to understand and to note that banks can fail for different reasons, and the appropriate rules and guidelines needed to combat certain failures might not necessarily do the job elsewhere. SVB didn't fail because it had bad loans, but rather because the supervision that was supposed to be in place didn't effectively address the maturity mismatches and the diversification as well. Elsewhere, New York community banks set off alarm bells in January with a surprise quarterly loss in provisions for credit losses. And while an investor group led by former Treasury Secretary Steven Mnuchin recently stepped in to offer a $1 billion lifeline, concerns remain over its ties to commercial real estate, according to the St. Louis Fed. Two-thirds of the CRE loans are held by community or regional banks, meaning if things would go sour, the industry can fall under very, very immense pressure. So the IMF globally warned in a global financial stability note last week. They said that the high concentration of CRE exposure represents a serious risk to small and large banks amid economic uncertainty and higher interest rates, potentially declining property values, and asset quality deteriorating. So, in the fourth quarter of 2023, a subset of banks remained with exceptionally high CRE concentration. For those losses could compromise their safety and soundness, and the turmoil also serves as a stark reminder of the impact that rapidly rising interest rates can have on by interacting with underlying financial vulnerabilities. Now, remember last year in March, right, when we saw this collapse and everyone was rushing to pull money out of banks, there was a massive fear in the market that sparked, and from there, realistically, the equity market didn't really drop, right? That was pretty much the bottoming into the end of the year, right, at that time. So things didn't seem so sour at the time, but right, obviously, if larger things like CRE takes a massive beat down on the exposure, it's most likely going to be different than what we saw last year. Regulators are tightening their scrutiny and attempting to stave off risk in the banking sector with things like Basel III Endgame and new rules that cover short-term liquidity and capital requirements. The question if these effectively target CRE risk, or on the flip side, if the whole matter with its dangers to the financial system is over sensationalized. Now, remember the deep recession warnings over the past 2 years that never materialized despite doom and gloom from industry leaders like Jamie Dimon, the CEO of JP Morgan, and also Jeff Bezos from Amazon. There has been cases of that recently as well, where you're seeing both extremes. I think it was I'm gonna butcher this. Who was it? Barron's on the weekend, last Friday, something like that, where they published a piece of Bet on the Bull with like the the cover page with like it was like paper or something and two bullhorns coming out. Like a lot of people, they compared that to the last time where they published a similar piece about the bear market that pretty much bottomed things out. So keep that in mind if people are starting to call for crash, especially after Friday's close. Everyone's like, "This is it. Sell signals on. One day is all it took." I'd be a little weary of that. Now, I'm not saying that we can't materialize some kind of a pullback, but um, it would have to happen over the next few weeks realistically to materialize before we start just rotating and continuing higher. There are no real signs in the current moment that we're starting to black swan or there's going to be some kind of massive turn down. So just understand that going forward. Don't believe everything that you see as we're trading into all-time highs consistently. When there's going to be changes in structure based on auctions and larger sells, you'll notice you'll obviously not be able to call a top most likely because it's a very difficult aspect in trading trying to find tops and bottoms. But you'll start to understand that there's going to be some kind of larger turnaround as it's happening, right? Trying to call this top based on one singular day, I think, is a very difficult thing to do. Now, in China, right? Chinese real estate firms that are seriously insolvent and have lost their operating capabilities must go bankrupt and reorganize. Those who commit acts that harm the interest of the masses will be investigated and punished in accordance to the law. Ni Heng, Minister of Housing and Urban Rural Development, said on the sidelines of the National People's Congress. China and Chinese property developers have been grappling with liquidity issues resulting in defaults and delayed payments, although Beijing also introduced a mechanism to raise funding for troubled projects. Economic and financial analysts also expect the property sector to remain prolonged and drag on growth. As we've seen recently, a lot of interest in actually investing in China over the past year, I would say. Well, maybe not the past year, but the past 3 months since the year started, right? They're still leading into some very large headwinds. So as it stands right now, like I said before at the beginning of this, we've changed the contract. I've rolled it over on the S&P 500. Another thing to take a look at this week is going to be watching semis very closely as we've had a massive red candle on Friday. See if there's going to be dip buyers or this thing's actually going to start dragging down. In terms of seasonality and from a cyclical approach, we're coming into a region where markets are expected to top out. Not super severely, but they're expecting to see some tops as we get into this area or this time period for a slight little pullback, and then we'll see how the buyers step into this. If we're talking about the S&P 500 and the futures here on the screen, this is the M contract. I'll reiterate that again, and we're still within some interesting areas. I think the 51.65-68 region is going to pose some kind of initial support structure to try to see if that buy side is going to come. But the way I see it is, as long as we're under 51.88, 51.90, heavy volume into that high, I think that there is still more motion for the bear side to come in and try to step into this market to push us lower. We start running back under 51.50 area, I think that it's pretty lights out until we see the 51.20, and from there you could see some kind of support structure. But as long as we're holding under 51.88, 51.90, and if we start running under this 51.65 area, I think that the probability of seeing more downside starts to exponentially increase as the day goes on. Now, again, quick reminder, we have CPI pre-market tomorrow morning. We also have today's going to be the day where there's going to be a decidedly increased number of contracts traded on the new M contract. So you're going to start to see choppier and more volatile moves. So just be aware of that as we get into this. That's all I had for today. I want to welcome you all at Trade Pro Academy, so you guys can go and check the website and check out our Discord, community.tradeproacademy.com, where generally on Fridays we stream live here on YouTube, but I'll be away starting Wednesday, so I'll see you guys tomorrow, probably Wednesday, and then I'll see you guys next week. So let's wrap that up. I just saw that comment, sounds a bit robotic. Damn. Well, this audio and this streaming always just kicks my ass for some reason. I'm going to have to try to figure that out, but leading into that, I hope everyone has an amazing start to the week. Let's get this week started, let's get this day ready, and we'll go from there. So thank you all, enjoy, check us out at tradeproacademy.com, and I'll see you guys throughout the week.